topic, that today we have been discussing on this Friday webinar with Ashwin from Axis Alternatives is the private credit space, which is actually mushrooming, especially in last 1 year, and it has actually picked pace after April of 2023, when the taxation of debt mutual funds relatively became less attractive, and many HNIs and ultra HNIs are actually seriously looking at this space for their fixed income allocation, and that has led to various players coming up with variety of products depending upon the understanding level of understanding and risk appetite of various investors. And in that, I would say spree, Access Alternatives has recently launched a product which is in the performing credit space, category 2, debt based AIF. We will be discussing that at length, that how is that product different from various other products. But before that, because Ashwin heads products and alternatives at Axis, it is important, Ashwin, for you to highlight in very simplistic manner, like we know, as we understand, in the space of equities, there are large caps, mid caps, small caps. Similarly, if you can explain, in the private credit space, what are the various types of lending structures, and how are those structures different from each other?
Yeah, so ultimately, the structure of any kind of a lending contract or a borrowing contract, and essentially, if it's a security instrument, then typically it could get structured like a bond or a debenture. But the core aspect of that is two parts. One is the interest, and the other one is the principal. So we start with that, which is that what kind of A, the quantum of interest, and B, the frequency and the rate at which interest comes back. So that's the interest part. And the second is the principal, which is typically how, again, the rate at which it will come, or where will it come? Will it come in the on a regular basis, and the back ended towards the end of the maturity of that, the tenure of that instrument, or when will it come? So these are the two variables, and when we call these funds structured funds, essentially the reason for the use of the word structured is that there is an element of structuring which it is possible to do. It is not that every single instrument has exactly the same formula in terms of what kind of coupon will come, or what is the frequency of that coupon, or when will the principal come. There is a third aspect also, which is when you're giving debt to someone, then you could have aspects around what is the security collateral, and what kind of protection that you have taken to cover yourself, and give yourself the ability to give yourself the chances of recovering this money in a timely manner. So either it could be in the form of some kind of a collateral, or some kind of a structuring in terms of the cash flow of the underlying that you give yourself access to. So to answer your question, the different instruments could vary in terms of the kind of cash flows they have in terms of principal and coupon. We have seen that typically coupons or yields in instruments are reflective of the risk that they run, typically the credit risk that they run. So, for example, in the risk-free in the country on a domestic basis is the government bonds, which is issued by the sovereign. So, therefore, from a credit risk perspective, investors do not face any. Starting from that, we can have a situation where it is starting from that, we can have a situation where you look at AAAs, and I'm sure most of us have heard about credit rating. So you have AAA, AA plus, AA, and so on. And the yields actually, which reflect nothing but the risk, the credit risk of the instrument or the issuer. And the yields typically reflect that risk, and typically the yields keep going up. So the yield can be, depending on the risk, can be high or low. And partly, so let's take an instrument that has, let's say, an yield of about 14%. That would reflect a certain risk. Now that 14% can come back to the investor either on a regular quarterly coupons. So that's one way of structuring it. The other way of structuring it is, you suppose it's a 3-year instrument. You say that instead of receiving this coupon on a quarterly basis, I don't receive any coupon for the first 12 months and then start getting the coupon after that, in such a way that the overall interest still comes to me, because whatever coupon I miss out in the first year comes to me in an added way towards the end of the period of that term of that bond. You could take it to the most extreme and say that you could have actually a zero coupon instrument, where if it's a 3-year instrument, there is no payment at all during the 3 years, and the entire yield, whether it is in the form of coupon or principal, comes completely on the back-ended basis. Likewise, the same formula can apply on principal. You can have something which is called redemption premium, which can help get a certain yield over and above whatever coupons you've received from the instrument. And the structuring can also be in the form of what kind of collateral comes in. So a simple example of a collateral is the most one of the popular structures which is there, which is, for example, loan against shares. So equity shares as a collateral. Now, if it is a company that is, for example, a listed company, and the shareholder of that listed company who owns shares, let's say worth 100 rupees, wants to borrow some money against that person's holding of these shares, then the collateral can be set aside, and you can borrow money against that, and that creates the security cover that the lender has. And tomorrow, if the borrower is not able to repay, then they can use this security cover and either sell these shares in the market to recover their money, or that's the most extreme scenario. So you sell that, and so that gives you that added level of protection in case there is a scenario under which you don't get your money back. So these are all different variables that happen. As I was explaining, the advantage of an AIF is that it's an unconstrained capital, in the sense that they have a free hand in structuring principal, coupon, security, cash flows. They have, therefore, they can look at their own mandate and decide which deals work, and whatever is needed to make a certain deal work or the risk acceptable. Those things can be clearly laid out.
So, what are the various, I would say, coupons or credit spreads for these variety of structuring and kind of underlyings that we have explained?
Yeah, so I think the market is, as you have mentioned also in the beginning, the market is quite a broad market. You have all the way starting from, say, 6-7%, all the way up to 15, 16, and all the way even up to 20%, depending on the instrument. Typically, the mutual funds operate in the higher rated side of that segment. So typically they operate from, let's say, up 6-7% to an 8-9%, at the higher end maybe up to 10% or so. Typically AIFs operate anywhere from 12% to about 16-18%. Any coupon above 16-18, it's not that it doesn't happen, but typically these are very specific situations, because there is something very specific that is a reason why such a high coupon is required or such a high yield is required in the instrument. And some of these could also be linked to some kind of a turnaround situation, or something that the company is going through some kind of a thing. But if you look up at regularity, then typically the 12 to 18 is where typically most of these regular situations tend to fall in, which is where most of the AIFs target. Now, different AIFs have different mandates. Some target, if you talk about this range, which is between 12 to 18, some target different segments within this range. And as I started off by saying, in a very, very big picture sense, risk and return, as we all know, risk and return are linked. In this case, higher yield is typically the reason you get a higher yield is because you're willing to take a slightly higher credit risk, and which is why you need to get rewarded with a higher yield. And that is why typically that is how investors should also look at it.
Sure. Typically, what I have seen, being on the investor services side, so there are venture, I would say, debt funds which would offer somewhere close to 18% or 18 to 20% kind of yield, they have been actually very popular, despite the fact that the fixed income space should ideally be looked from the point of view of risk first and maybe return later, logically speaking. But still, investors are always more attracted to higher return giving and higher risk type instruments in the private credit space. Now your
I think
take.
if I were to just respond to that point, I think it's also you have to look at the history of this instrument. I think uh, uh, before 31st March, there was a very uneven tax regime, right? As we spoke about in the beginning, AIFs were taxed typically very differently from how mutual funds were taxed. And for a lot of investors, that created a big hurdle in considering private credit kind of AIFs. So a lot of the traditional AIFs, which are today possible, which are offering a lower yield of, when I say lower, relatively lower yield of say 13, 14 or 15, 16%, in did not find that many takers in the older times because of the higher tax leakage. So willy-nilly, the market started pushing towards the higher yielding structures. What we are seeing now is, as the tax angle has become less relevant, it's a level playing field. You are seeing a proliferation of different products in different ranges. So that becomes, now it's become actually possible. And actually what we are seeing is that there are different investors who want different things. It's not that everyone is only shooting for a high. I think there is, within the informed investors, and typically AIF is an informed investor product because it can only be pitched to sophisticated investors, more than a crore investment. So it's not a retail product. It does not mass market it. It is only privately placed. So in that sense, today, when we talk to investors individually about the offering, what we are seeing is that there is a realization, and a lot of investors willingly are willingly looking to talk to, say, an AIF manager that is offering a private credit product which is targeting a 13-14% yield versus another one that is targeting 16-18, because then they realize that the difference is also factored in by the risk, which is different for these two products. It's not just a straight and simple yield formula that we are working with. So I would say there is a big sea change which has happened post 31st March as the situation has changed. And I think I'm very positive, in fact, about the fact that you will start seeing this differentiation, different segments, all will do, again, nothing wrong or right about it. It's not that any one segment, you mentioned venture debt funds or you mentioned other funds. It's not that any one fund is right or wrong compared to another fund, but the beauty of the market and the maturity of the market comes when different funds are available and investors have the choice, and they are able to take that choice using risk return, not with because of tax distortion or anything, but using the risk return, the rationale at their end.
So, what motivated Access to actually, get into the performing credit space, which actually I think is on the lower end of the yield in terms of coupons, and in terms of risk also it is lower.
Yeah.
So, do you see a lot of clients actually giving more significance to risk, which logically is right in the fixed income space, but we know how investors ultimately emotionally take their investment decisions. That's why I was trying to
Yeah.
ask this question.
Yeah, no, understand. And I think that's where it's very important that I think SEBI's been very careful in the way they've structured this AIF thing. And it's that's why they don't allow us to mass market. We are not advertising this product. It's ultimately a privately placed product. We don't talk about the details of the product in mass media or anything. But essentially, when you talk to investors who are interested, uh, these are typically investors that are more sophisticated in nature. As I mentioned, minimum 1 crore, and these are investors who typically have some history around debt investing, which they have understood. They understand, as I was explaining in the opening remarks, the whole journey of the credit risk funds, where people have seen that there is nothing which is, if there is a risk, then that risk can play out. A lot of people thought that credit risk funds, people went by the YTM and people went by the yields, and they felt that that is the return that they will enjoy. And somewhere down the line, people saw that when scenarios change, when risk plays out as it played out in 2019-20, then the actual return clearly gets affected by that. So that I think that lesson has been there in the market. Many investors have seen what has happened. So I would say today, as a market, we are much more mature and we are much more better understanding of credit risk than, let's say, 5 years ago or 7 years ago. Obviously, it also means that investors are being much more cautious, but slowly and steadily, I think they are recognizing the power of this instrument. So, to answer your question, yes, the informed investors, the more sophisticated investors, are willing to look at yields that work for them. They are not just blindly going for higher yield. And why Axis has chosen this, I think it's not, again, as I will repeat what I said, which is not that there is a right segment or a wrong segment. It is just a reflection of what we felt were the opportunities that seemed attractive to us right now, and our ability in terms of being able to execute this in a good way for our investors. So, given our capabilities, given the underwriting capabilities, the origination capabilities that we have, as well as the kind of opportunities we were seeing in the market, this was the segment that we felt, we could do justice to, and we believe that we were very confident about, and that's why we've done it. Does it mean that we will always be in this segment and not in other segments? They need not be. If we get other opportunities down the road, 2 years later, few years later, we could look at other things. But for now, clearly, this is a very attractive space to us. This There are lots of opportunities that we are clearly seeing. Let me explain also the reason for the opportunities we are seeing. After many years, today a very good situation where corporates have deleveraged. There used to be a big overhang of debt, both at founders level, at companies level for the last 10, 12 years. We have seen consistently that people have raised equity, people have worked off debt. Today, their repaying capacity is much good. Point number two, economy is doing really well, and the growth potential is definitely something that people are convinced about. So, as in many of the industries, we are seeing a lot of investing happening in terms of new capacity, new capex. Some of it is also driven, as we all have heard, in terms of the production movement happening globally from China to other places. In India, we are seeing a huge potential for that to happen as well. So it is all pointing towards a scenario where there's a lot of spending, investments that companies are going to be, A, they're already making, but B, also from an opportunity perspective, they're likely to make going forward. So this is a very perfect situation where companies are deleveraged, banks have a very high, generally financial system has a very low level of bad debts, and companies need to go a capex, and the demand for credit is going to go up. So this is going to be a very healthy market, and that is where our confidence is also coming.
So typically, how does, I would say, selection of companies and deployment of funds happen in case of such funds?
So typically, you see, for any AIF or for any fund, the most important thing is, risk diversification. You don't want the any fund to get affected disproportionately by any one sector or any one instrument. So typically, that's one of the things that people do, which is they try to keep allocating across different sectors, themes, opportunities. Point number two, a lot of these funds, because these are structured credit instruments, there's a lot of time and effort that goes into structuring both cash flows and security collaterals to make sure that the risk that the fund is taking is managed in a reasonable way. Um, we are seeing a lot of effort that goes, and we know in Access we are looking to do that for in as well. in terms of understanding the actual ask that a borrower has. Typically it could be some kind of a situational need for capital because there is a certain event that is going to happen. Maybe it could be some kind of a bridge requirement, funding requirement to some other liquidity event down the road, or it could be some kind of a more structural requirement like capex or something that it's important for us to understand the reason that the borrower is looking for the money, and making sure that our instrument is providing a solution to that borrower. In terms of making sure that the cash flows work for them, the collateral works for them, without compromising the risk at our end. So if we can do that, if we can make it work like a solution, then that's the best risk management also, because that's any instrument that is workable or working for um, uh, I'm sorry, is there a problem with the link?
Working fine.
Okay.
Fine, yeah.
Yeah, so if there is a um if the solution works for the investors, for the as well as for the borrowers, and that's the best risk management that is possible, because you're giving someone, the lender, the best chance to use this money towards the opportunity that they were having, as well as being able to repay it in a timely manner and get the yield that the investors are looking for. So to summarize, I think diversification, strong underwriting, and using the structuring of the cash flows towards helping bridge expectations from both lenders and borrowers. These are some of the things that funds can do to help manage the risk of instruments like these, or products like this.
Sure, Ashwin. So, in case of equity funds, there are certain do's and don'ts, certain sectors defined, certain like market segment defined. So now let's talk about your product, which is like performing credit.
Yeah.
So how do you define the target universe of your product? And maybe before that, you can cover what is the meaning of performing credit.
Yeah, no, good that you asked me that, Kamal, because it is a word that gets used, and sometimes people. So I think the way to understand performing versus non-performing is that, are you lending to companies that are regular on their debt repayment, and that are regular in terms of their existing capability debt outstanding, or whether these are companies which are under some kind of a stress and they have fallen behind, or they have some kind of a challenges in being able to meet their existing liabilities. So those are the two scenarios, right? You could be companies that are doing well, they are on track as far as their existing liabilities are concerned, but they have need for more funding, maybe because of some additional requirement that has come, or some situational issue that has come. So typically that scenario is what the performing part of the performing credit comes from. As opposed to, you could have other scenarios where it could be a more special situation, or a non-performing or stressed, whichever term you want to use, where the company involved is going through some kind of a challenging scenario where they're having some trouble with meeting their existing obligations, and they're looking for a solution that can help them get out of that situation. Now, those things can also be very interesting opportunities if they are done right, but those are very different kinds of risk profiles, which are special situations or stressed, distressed kind of offerings that are there. But in our case, it's more of a performing setup, where you're talking about healthy existing operating companies, or promoters of such companies, or holding companies of such companies, which have clear, which are looking to take additional debt for, like I said, some kind of a situational context.
Sure. Can you explain this with an example of a company and how deal gets structured? What kind of collateral is taken? Total tenure, kind of coupon. How does that coupon come? How does the premium redemption premium comes? Maybe taking an example of a particular company in particular industry.
Yeah, so if I were to take, let's take an example of a manufacturing company, and let's say that the company is looking for some kind of a solution around um, some capex that they need to do. And now the issue here would be that there is a certain amount of operating cash flow, but given that the capex may take time to for them to do. They may need some kind of an elbow room in terms of structuring of the cash flows and the ability to pay it back. So you could structure the instrument, say, as like a 3-year instrument where the principal could be made back-ended. So company doesn't need to worry about repaying the principal for the first 2 years, and the money that they raise from this goes into their capex spending and gives them the time to stabilize that new capex and get the operating cash flow going and have building up the ability to repay us down the road over 3 years. So that's the part of the structuring that can come in because of the ability to structure principle in a certain way. Now compare that to a separate illustration where a company has a bridge funding requirement, and they expect maybe there is a receivable that they are expecting over the next 6 to 12 months, and so it's not that they need money for a new capex or something, but there is a certain amount of receivable that has not come, and against that they have some cash funding requirement today. So you could create a very different structure where you could have a shorter tenure, and your principal repayment could potentially start from 12-month onwards, with a very clear understanding that there is the ability for the company to repay it faster if this receivable comes through in the next 6 to 12 months. So you create that flexibility in the structuring, looking at what the context of that company is. That is on principle. Now, point number two is interest. In the case of a capex, again, you could create a scenario where even if the yield is, say, 13 or 14%, given that the company is looking at maybe not having some clear cash flows in the first 12 months, you could create some lower coupon in the first 12, 18 months, which goes up over a period of time. So that is one option. In the case of the receivable one, you could, even because you know that it's going to come in 6 to 12 months, you could create either a zero coupon or a 12-month moratorium as well, because it gets repaid in the basis of the receivable coming out. Redemption premium is an interesting one. Redemption premium is essentially when you get your money back from an instrument like an NCD, you can either get it back in the form of coupon or your return of principal, but you could also get something over and above the principal when the NCD redeems, and that additional amount is called a redemption premium. The premium can be structured in such a way or calculated in such a way that you get a effective yield or effective IRR, which can be a certain number that can be targeted. So in this case, for example, if you are targeting 14% yield, effective yield to the investor, which is the AIF, then you could create and staying with the manufacturing company example, and if you have lent for 3 years with a capex situation and there is a lower coupon, 14% is too high from a regular cash flow perspective, because the company needs the money in the first 12 18 months to do the capex. Then you could create a much lower coupon, but then as investor, how do you then realize your 14% yield? So if the coupon is lower, say only 8%, then where does the balance 6% come from? And that comes from the redemption premium, which you as investor become eligible to get when the 3-year maturity gets over. So you get some lower coupon during the life of the bond, the NCD, and when the principal comes back at the end of 3 years, you get back not just the principal but this additional redemption premium, which effectively ensures that the overall IRR or overall yield as an investor that you enjoy for this period becomes 14%. Now comes the question of security collaterals, etc. So typically that depends on the kind of entity that you are lending to. If it's an operating company, then the collateral could be the assets of that company, the cash flows of those company, and you could get some kind of a charge there. Or alternatively, let's say in the scenario where there is a certain receivable, maybe it's a holding company, then you could take a security which is the shareholding or shares or some other collateral, additional collateral that the borrower can provide us to help provide security or cover against this lending, this instrument, this NCD. The So these are all the different variables which are possible. The beauty of this market is that there is no one fixed formula. So whatever I have explained, there are so many different variations which are possible to this, depending on the specifics of that. You can play with the tenure, you can play with the coupon, you can play with the principal repayment, redemption premium. You can play with the collateral and security. These are all things that uh, provide a lot of flexibility to the fund manager, and the as a result, companies also really get a lot of value when they deal with AIFs. And today, for a good quality company, typically they do have relationships with banks and NBFCs, and they have access to a number of different credit options. So we also get a lot of question of why somebody who has a banking relationship should work with an AIF and offer a yield which is a higher yield of say 14%. Typically, banks for normal bank lines or working capital lines maybe or making it available lower. The answer is that many companies may choose not to go to an AIF for a traditional vanilla kind of opportunity. But when it comes to a more specific opportunity which is requires this element of structuring which I just spoke about, then that is where an AIF can be quite nimble, and they can be quite flexible in terms of how they structure it. And companies really appreciate being able to have access to pools of capital like that. And that's where many of the even good quality established companies who can otherwise borrow at lower rates, maybe from banks, etc., for specific scenarios, are happy to talk to AIFs and agree to these kind of higher yields. So that's the broad contour of the choices. Like I said, it's really is a lot of flexibility that is available.
Sure. Still, apart from all this, in terms of SEBI's yardsticks and all, despite all that, still, obviously, none of the product is free of any risk. So, how is it that investors should kind of actually evaluate between selecting, on one side, a very high return giving instrument like a venture debt fund, or a performing credit like a, Access performing credit fund that you guys have launched? Obviously, in terms of returns, we understand, and in terms of risk, ultimately, what can go wrong, or, what are the kind of expectations that investors should keep in mind?
I think, as I said, ultimately, it's what investors need to do, and when they come and they talk to us, we do explain this to them on one-on-one. Is that they have to understand our thinking, what are the steps that we take, what kind of the deal selection methodology that we have, what kind of underwriting process that we follow, to get comfort around the fact that what is our philosophy with this fund. And likewise, any other product, you give the example of venture debt or any other segment, investors need to compare it with that. So, for example, a venture debt, just to give a contrast, typically deals with early stage companies which are still relatively small. In many cases, they may not be profitable, they'll be loss making. Typically, therefore, they are while they may have a higher risk in their ability to repay, but you can also charge them yields which are much higher. And in many cases, venture debt funds are also able to get some equity upside by getting warrants or some kind of equity upside from these companies which are in early stage in a very high growth phase. So it's a risk issue. People who are looking at evaluating that versus performing credit, That's the contrast you need to keep in mind. A regular performing credit is talking about more established companies which are already sort of operational in nature, typically tend to be profitable either for those companies you're lending at that level or at a holdco level, what we call a holding company, which is a company that owns shares in these companies. So typically, those are the type of situations a performing credit product looks at. So because these are much more established, relatively more sort of predictability, higher predictability of the cash flows of these entities, they are perceived to be lower risk and typically therefore operate at a much lower yield. We don't typically look at any kind of equity upside here. We do not seek any kind of equity, either warrants or equity kind like additional payoffs, but typically much more on a fixed yield basis that it gets done. So that's the contrast. Very different risk profile. Performing credit typically, therefore, like I said, much more of focus on existing operating kind of companies in traditional sectors that we typically look for.
Sure, in the performing credit, space, because the returns are relatively lower to any other, category of products. It is also very imperative to understand what is the fee structure, because if like you're lending at lower risk, very yarded and very good structuring of deals, it does give comfort to investors. But because returns are like 12 to 14%, and there will be a kind of, these returns get taxed at marginal tax rate, it is important to understand what is the net yield. If gross is say 12 to 14, what is the net yield in the hands of investors? Say net of taxes and net of expenses, and then obviously net of taxes.
Yeah. Typically, the expenses can be in two parts: the fixed fee and any kind of either carry a performance fee or whatever way in which a variable fee is called. So there's a variable and a fixed fee structure that AIFs normally follow. What we have seen is that the more complex strategies are typically strategies that are operating at the higher end of the spectrum have a higher element of variable fees as well. So if the fund manager is able to deliver the higher yields, they also get to charge a part of that higher fee as their own carry or share from the higher fees over and above whatever fixed fee that they are charging. And what we have seen in the performing segment, which is the segment where we are, typically there tends to be much more focus on only the fixed part of the fee, which is how we have also structured. We have looked at only a fixed fee component, and we're not really looked at having any kind of variable fee. In terms of the yields, therefore, broadly what happens is that whatever the gross yield the portfolio is able to achieve, effectively there is a good visibility that investors have in terms of how that will translate into a net yield, because the expenses are fixed. It's not that you pay any additional variable fee or carry on top of the fixed fee as well.
Sure, I think this is quite interesting. Risks are low, fees is low, liquidity is high. So obviously, this makes uh, the product attractive. But still, maybe as a last question to this webinar, if you would want to address, who do you think is the right target profile of client for investing into a performing credit, and what is it that is kind of uh, mentioned or advised as an allocation
Hmm.
of portfolio for such an investor?
Yeah, I'll just add to point you made. So for example, but the risk is low is a relative statement, right? Obviously, risk is not low relative to a GSEC or a AAA corporate fund. This is much higher, but relative to a venture debt or a aggressive fund, this is a lower risk instrument. So that's just investors need to keep that in mind. Point number two, liquidity does exist in the sense that people, the way these funds are structured, some regular cash flow from the coupons comes back to them. But at one level, there is no liquidity because AIFs have a hard lock-in, especially category two, have a hard lock-in. So any investors who come in, there is, unlike say open-ended mutual funds, there is no exit which is possible for them. And So that's the context that is there. for investors to keep in mind. So yeah, those two things I just wanted to clarify.
Sure. Typically, what is the right kind of investor profile?
Investor profile, yeah, yeah.
Yeah.
So investor profile, I would say investors who uh, I said this at the beginning also, that typically AIFs anyway, from a SEBI perspective, are meant for more sophisticated investors. There is a minimum ticket size which is very large, which is 1 crore. And as I was saying just now, this is also, keeping in mind that these funds have a hard lock-in and there is intermediate exit, which is not possible. So in a way, what this tells us is that these are investors that have a very high discretionary sort of capital available to them for investing. So I would say these are the two things to keep in mind. Investors that have the ability to, allocate money for 3 to 5 years, or typically 5 years or so, and sort of not, while they may get some regular coupon, but that money gets locked up. So people who have the ability to allocate that. And point number two, maybe some sophistication in understanding of credit risk instruments, as the point that you have been repeatedly making. I think it's people cannot blindly just look at any kind of a gross yield and allocate. They should be able to understand what the fund is trying to do and whether that fits in with their own overall portfolio objectives or not.
Right, Ashwin. So I had asked this question particularly because I know you have recently raised substantial corpus in the earlier fund in the same category. How was that fund different, and how much corpus was raised, and what was the typical type of the profile of the investor who was investing in that fund?
No, so the profile was the same. The profile has not changed. In fact, the fund mandate was also somewhat similar. It was not that it was very different. It was a much smaller fund. What we're doing now is much larger. The older fund was only about 200 odd crores. We're now looking to a much larger, more 1,000+ crore kind of a product.
Sure. How much is the skin in the game, from the fund manager or investment committee in the
So
fund that we're talking about? This is the last question, and then we'll give the closing remarks.
yeah, so those are, we put those things, we share that. I mean, certain amount of money that we need to put in as investment manager as a part of SEBI requirements. We do as confidence capital look to add something over and above that as well. So we are looking at having a pretty substantial allocation from our side into the fund.
So thank you so much, Ashwin, for giving your time today. So this space absolutely has been flourishing, and we get many queries from our clients, our prospective investors who want to inquire about this space. And ultimately, we know there are a variety of products in this arena, and then hence it was important to explain to all these investors, subscribers to our channel who will watch the video recording of this detailed discussion on various types of structurings that can happen in this particular category 2 of private credit, which is obviously ranging from 12% to 20%, and that range is quite broad. Obviously, this is kind of to be understood both from the point of view of risks as well as returns. But again, as you also rightly mentioned, the risk is more of a matter of understanding and maybe a time horizon and liquidity. And at the same time, because we know ultimately substantial percentage goes into taxes as well as in expenses, it is important for investors to actually make a right decision for themselves, and hence performing credit actually makes a good sense, because in any case here one is paying lesser taxes, one is paying lesser expenses, relatively lesser risky also to the other category of private credit funds which are higher on the risk. I specifically mentioned that in terms of the venture credit. And absolutely we look forward to kind of understanding in detail from the product deck of your private credit fund once we have that. And this was a normal, I would say, educative webinar for our audience to kind of explain them about this category and how this is flourishing. Thank you so much for your time. Thank you everyone for logging in today.
Thank you. Thank you, Kamal.